Joy Business, and is brought to you by Goyle. Goyle, they say, good energy. Goyle Yanara Yedia. It's the 26th day of May, 2021, and you're tuning to Joy 99.7 FM. Masterclass comes your way every Wednesday afternoon from 1:30 p.m. all the way to 2:15 p.m. on this Super Dial 99.7 FM. It's the fourth month of the year. No, sorry, we're in the fifth month. Yes, it's the fifth month, the 26th day of the fifth month, and it's therefore something you'd want to be able to rise up, move, do some good things for yourself. And as they say, time and tide waits for no man. I am not Yabanafo, who is your regular host. My name is Nhyira Addo, and I will be your host for today's episode of Masterclass. So, just to remind you, we're streaming live on Facebook at Joy 99.7 FM. And you can also watch us right there. And if you should prefer to have an audio-visual experience, that would be the way to go. Last week, we started a conversation on bookkeeping and accounting for small businesses. Today we continue with the conversation, and joining us for the conversation is a senior finance consultant at Firstcode Management Services, Mr. Kwaw De-Graft Johnson. Mr. De-Graft Johnson, you're welcome.
Yeah, thank you.
I followed your conversation with Yalbana for last week, and super insightful, and I'm sure that today will be no exception. So you shared a few thoughts with us on the simple principles like liquidity, cash flow, profit, depreciation. You also went on to explain how small businesses, can absolutely, or the importance of absolutely keeping records, recording everything that comes in, what goes out, so that your profitability is very clear to you at the end of the day. What was important in that conversation of note was that any good financial person, once they pick up your financials, will expect a certain trajectory to the numbers that have been presented. They must tell a certain story, and if there's a disconnect between the numbers you present and the story they tell, or they are supposed to tell, then you will be found out to have not kept your books well. That's where you hear expressions like people cooking the books and things like that. And so today we will continue, and we're privileged to have us back in the studio, Mr. Kwaw De-Graft Johnson. So I'm not going to take too much of your time. I think that the audience would love to hear more from you. So I'll hand over to you. Again, you're welcome.
Thank you. Last week, we basically looked at bookkeeping.
That's right.
That is just recording all the transactions, events, operations of the business in monetary terms.
Mm-hmm.
That I said, any business owner, you don't have to be an accountant to be able to do that. Now, so the accountant moves in after you've got this bookkeeping data, which I call data in that sense. Then he will analyze it, classify it, summarize it to give you the financial statements. And these financial statements now are information which can be interpreted and used for decision making. Now, the financial statements are what represents the business in its entirety.
Okay.
Now, you know that if you're setting up any business, there's risk.
Absolutely.
And that is what the business owners who don't want to prepare financial statements don't seem to understand. There are all kinds of agencies, government, banks, and others who want to support SMEs. Now, in order to get funding from them, you need to meet some minimum requirements. One of them is present your financial statement so we look at it, and you don't have the proper thing. So as soon as any analyst looks at it, he can tell that this is not something I can rely on, and you don't get it. So today I want to look at this side that you are the bookkeeper of your, you've done the bookkeeping.
That's right.
You've called in some professional called accountant, maybe the auditors even come, and they presented financial statements to you. Or you're a director of some company or the other, they presented financial statements to you. You are not an accountant. What are the kind of things you must look at to have a sense of what information is being given to you? Because you're going to take key decisions on that. So we know from what I said last week that most of us understand P&L, your income statement.
Yeah, that's right.
Your balance sheet, your cash flow, the notes that go with it, and then, of course, the changes in equity.
Yeah.
Now, I'm going to go one by one and a bit slow down a bit.
That's
So
right.
they've put a P&L in front of you. And what do you look at? And we always tell people that you just have to go back to the mathematics or arithmetic you did in secondary school
Okay.
and use that kind of analysis. So I'm going to go through that because you can, the financial statements are subject to analysis. And I'll call them vertical. That means you're comparing figures on the same line.
Okay.
Horizontal, that is you're comparing across years. And then the accountant now comes in with a sophisticated one that involves statistical things. But the two, the horizontal and vertical, anybody can do.
Can do that, yeah.
Or you need to take your calculator or use your Excel. So let's take the basic one. Let's say you're in business. You sold something for 20 Ghana. You bought it for 15 Ghana. So you made a profit of 5 CDs.
That's right.
That is what we basically call gross profit, the first line for it, because you haven't taken out your other costs. So
That's
you're a
correct.
business, right? Now, there's some mathematics you can do. The 5 CDs, what percentage is it of the sales you made? So 5 over 20, that's 1 over 4, that's 25%.
Right. So 25%.
Then you
yeah.
call that 25% your gross profit. Now, you had 5. Now, your other expenses, like maybe your own salary and things, maybe it was 3 CDs. You take that one out. By taking it, that means every conceivable expense you can think of, which came from that, you've taken out. So now you're left with 2 CDs. 2. Now, 2 over 20, right? That is
That's
1
1
over
10. Yeah.
So that immediately gives you a percentage then, 10%. And that's what you will call your net profit margin.
Right. So the gross profit
Yeah.
is profit you've made from your transaction.
The direct ones.
Cost, not all your cost.
Yeah, the
but it's
direct
just the
ones.
direct ones. So the
Yes.
direct price of your transaction.
Yes, and the direct
and the
expense.
direct expense.
Yes.
And now you have to calculate all the other costs. So your
Yes.
statutory and
Your
other
rent,
costs,
all those
of
other
that.
things.
What you're left with is now your net profit. Okay.
Yes. But then the taxman will come in a bit before you can say the rest is yours.
That's right.
Yes. Now, so you have that percentage. Now, assuming that was for 2019, then 2020 COVID setting. So instead of 20 you sold, it was now 10. Right? And let's go right there and say instead of making a gross margin of 25%, it's reduced now to 20.
Okay.
Now you have a comparison. That tells you straight. You see, you use percentage because then it's a common platform to compare various years and so on. So 9%, the figures are different, but percentage is giving you the same level of measure. So now you realize, oh, last year I did 25%. No, 2 years ago I did 25%. Now I've done 20. It should now tell you, oh, I didn't do so well. Maybe going down, instead of 10%, you now made 5% net profit margin.
That's correct.
So now it's clear to you that, oh, you didn't do too well. But that's not, now this is what I'm calling the vertical. Now you have the horizontal. You can look at it that last year it was 20, or the previous, we are in 2020.
Yeah.
Yeah, you had 20, now you had 10. There's a difference of 10.
That's right.
So you are now looking at increase and decrease over the previous year. This is the horizontal.
Okay.
So it went down. So 10 over 20, that's 50%. So now you know that your sales figure went down by 50%. So you can do this line by line by line. And now, and especially with expenses. So now you call the person who prepared it. Why did sales go down? Right? Especially if you analyze the fund, maybe you sell 4 different types of products. So you have been able to do that for each line. So it will tell you the various percentage that composite gave you that 50%. Why didn't we do well this year? And I told you because of this or that. Then you are getting better insight into your business.
From the information
Yes.
provided.
You now come to the expenses, for example. Hey, why did the salaries go up 31%? I know so these are top managers. They resigned. I thought that it would go down. So, sir, you remember there was a salary increase that we brought in. So the salary increase and then those other stuff we took. So the net of it is this 31% increase. See, so you do this kind of analytical review. Just using mathematics, increase or decrease, and just relationships. Then it starts to give you information and you ask questions. Because this will then give you an idea of what you're doing. For example, if you went to a bank, an average bank will ask you for 3 years. So at least it will give you 3 measures for which you can get at least two comparisons. As you said, it starts to set a trend. Are you doing well or you're not doing well? What are the reasons and so on? Now, mind you, the accountant has to prepare accounts according to a certain set of rules. So all the key figures that will be necessary for decision making, he has to make it, we call them disclosures. He has to disclose them. Just in case you took a loan, the interest we want to see. We want to know your depreciation. We want to know what salaries you gave, and we want to know what you gave to your directors.
Right.
We want to know your audit fees. We want to know, let's say, electricity. No, there are clear categories so that it's comparable with it, even other companies. Right. Now, so that will give you an idea of what the profit and loss statement can give you. Then you will probably then look at your balance sheet. Now, one of the first things I tell people to do with balance sheets is that you may see figures, but they may not, when you add them up, be the same. Maybe you can put any, because although IT can do that, it's supposed to give you the right. You just go by the basic adding.
And just add.
Yes. You have all your assets. They will have a figure, total assets. Just look at that figure and see whether it adds up with all the liabilities there, and then you, the shareholder, what you have put in.
That's right.
The two figures, when you add them, the total assets and then the shareholder funds plus the total liability, they should be the same. Because they are both sides of it.
The same, yeah.
This is what came in. This is what it has brought in. They should be the same. Just for a mathematical accuracy, because sometimes, these small mistakes like the electoral commissioner, so, small mistakes like that can...
And it changes the complexion of the conversation.
You need to know whether it's the same. Then, there are some analysis. The basic one that I think most people want to look at is what I'll call the current assets. I was explaining last week what current assets are. Like you have some stock. When you sell it on credit, you are going to get trade debtors. It's when they give the money before you get the cash.
That's right.
But if you sold it as cash, that you get cash. So all of three of them are easily interchangeable into cash, and those are what we call current assets, right? The other leg of it is what we call the current liabilities. Those who gave you things on credit, so you owe them. And maybe you even owe the tax man in your accounts. Now, these are supposed to be transactions that you should execute within a year. Now, what happens is that anybody looking at your accounts, and that you are the man you are looking. Now, let's say all your current assets was converted to cash, and it was, say, 200. Then all the liabilities there are 100. It means if you cleared everything from your bank to pay all you owed, you will still have 100 Ghana as asset.
That's right.
So they're going to look at the current assets and your current liabilities. So if it is above, and normally you in this example I gave, it will be 2 to 1. If you look at it, it's double.
That's right. It's double.
Yeah. The higher it is, the more you are able to pay your debtors as due. So if it were the reverse, you have only 100 in your bank balance, and then you owe 200. It means if you took all that money and paid, you still owe, and that's high risk. So you have to look at these kinds of comparisons, and it gives you an idea of what is taking place. Then I think I'll go and then jump to the cash flow, because the cash flow, you see what you mentioned, depreciation. What we see in the balance sheet is not the actual value of, say, the fixed assets you have.
Okay.
We have discounted it by wear and tear. So that figure is not the, So assuming in that year you bought new assets, maybe a few cars or whatever, 60,000 or 100,000.
Or even
whatever.
furniture.
Yes, any of those kind of, It is in the cash flow you see the actual amount that was used to buy that.
Okay.
It's also there that you'll find out how much you've paid as tax. It's there. The rest of the statements will let you know whether people have given you money or you've given money out. So if last year your creditors were maybe the same 200, and this year is risen to 300, it means that the creditors have pumped more money into your business, an increase of 100. So you will see increase and decreases in the figures and the current assets and current liabilities. If it is a positive figure, it means money has come in from them. They've given you money. Right. If it is negative, you have sent
you
out
are the
money.
one sending out money.
So when you look at the three, it gives you quite an insight on the operations of the entire business. Mind you, somebody else is going to look at it and make decisions on whether you are credit worthy or your risk profile, because it's going to use it to make a judgment of the financial health of your company. It's going to decide the performance, whether it's acceptable to, and even your business value. Is it falling in value and so on? So you need to.
Isn't it possible that through that information, the analysis would also reveal the sort of governance you have over your finances?
That is precisely the point. Then you come and suddenly realize, hey, we haven't been managing things. The expenses are too high. No. This and it just gives you reason to start thinking strategic. What kind of changes can we make to improve things? If it's a risk, what can we do to mitigate it or reduce the risk? And, improve on performance. Are you getting me? Because most people don't see it that way. The moment they get the information and take your small calculator or and start to analyze, you suddenly realize that, hey, these are not what. Last week, for example, I was explaining keeping high cash balances in your current account will earn you nothing. When the banks have told you, you can put it on call, you can put it on fixed deposit, you can even buy treasury bills and earn something on it. So all these cash management, treasury management functions are there. So it's only when you're looking at your finances in this thing. But this is you, the ordinary non-accountant who is a manager or business owner. Some of the things you look at. Because whatever it is, this is what you are going to present to the outside world. That's the only way they are going to judge the performance of your business. So if you do this thing, you might be able to now see areas that you've gone wrong and need to correct. Because as you mentioned, the governance aspect of it is showing that if your financial statement has been well prepared, it's clear that you're following it gives an idea that the people running the company know what they are doing. See, people forget. You can go to a place with very good accounts, and they start to ask you, the manager, questions, and you don't understand what you are doing. Then you might have and then that can, yes. So you need to own up, understand what you are doing, and speak to it. But a lot of people, it doesn't matter, do anything for me, and whatever information you give to your auditor is what he's going to use. So if you hid a lot of things and brought documents to support what you did, that is what he's going to prepare on. And maybe if you are giving him more insight, he would have used his understanding to classify things a bit differently, because sometimes the kind of description given that will make the accountant put it either at A or B or C. I'll give you an example. The microfinance companies, the troubles they got to. A lot of them got into trouble because of wrong classification. When you classify something as deposit, it has a different meaning to the regulator than if it's a borrowing.
Okay.
And some people just lumped everything to deposit. If it's deposit, 30% of it, you can't use it for lending. That's 20% may have to go into treasury bills and another in cash. But if it's a straight borrowing, it's outside it. And you have to get a proper documentation. And it gives you freedom
to be able to.
But they just felt any money is any money and all those things. So, some of them, by the time they were aware of what they had done, shot themselves in the foot, because that's what you sent to the regulator. He calculated certain things on it, and he said, no, you have to shut down. Because, the moment you take money from people, you create a risk that, as it were, government and so on are supposed to look at. And so the whole essence of all these things is to manage risk. We gave you money. Are you able to give it back to us? So if I was a supplier and I wanted to supply your company with something and you wanted me 3 months credit or something, I would want to look at your financial statements to see whether it shows that you really always have cash. Your current assets are such that if I gave you, you will be able to honor your promise. Yeah. But you are preparing it anyhow, and you are unaware that these are the things that will be looked at. And as I said, these are the fundamental ones. We are actually focusing more on the non-accountant.
Exactly.
These are the things you can. Then when you ask the accountant, and he starts to explain, then you get a fair sense of what you are doing. Because the moment you go and ask for a loan, and you give it to a banker, he will use even more sophisticated ratios, right? He will start to look at your debt equity. That means how much of it you owe, how much of it is your equity. He will look at your total liabilities as against your total assets. He's going to run a whole lot of things determining what kind of risk your financials present to him. And if it's too high, then I'm sorry, they can't help you. See, so we keep trying to, here at Firstcode, what we are trying to do is to get business owners. Come, let's have a talk. Let's explain things. Take your own business records, for example. We'll go through with you and explain things. You are a startup, it doesn't matter. Come, we'll show you bookkeeping. Because it's frustrating when even the bankers complain. We have a lot of money. We've sent SME desks set up. And when they come, they don't qualify. You know,
And it's because the fundamental thing which is
not
keeping the book is not
see
there.
that, look, sometimes can't you look, I'll send you somebody here. Just guide him for 6 months to a year. Then he will qualify. He's doing good business, but we can't give him money because he won't put the money even in the bank. So every time we are not sure he's putting himself in the business, some personal expenses are in and so on. So we just say, look. The business is separate from you. Understand that. And start separating them so that when somebody is analyzing your business, then we know. The taxman comes and he may tax you a whole lot of things because you didn't explain very well that, the trip you took to, let's say, UK, and went with your wife. Matter of your reason you went was business. And so most of the time you were doing business, but you went for your wife. That description will change what the taxman is going to see. Oh, this is part of a business. Okay, so maybe part is business, part is this. Or is it part of your entitlement as the owner of the business? We probably put it there that once a year you can take your family out and so on. But if you don't give disclosures and he sees something he doesn't understand, he'll just add it back and tax you. Then you complain that the tax auditor came and put your records clear, because there are a lot of discretionary things that are in the taxman can exercise.
And it all starts with ensuring that you're collecting and reporting on the data, and having a professional help you classify it properly.
Yes.
So that it follows the right, it basically satisfies all righteousness.
Yes.
Okay.
I like that term.
Okay. This is Masterclass, and it's coming to you live from Joy 99.7. It's 1:54, I believe. And as you know, this is brought to you by Goyle. And here's some very important information. Now, we're all going cashless, and it's never been this convenient and exciting. Goyle e-payment system is now compatible with GH Link, the national payment platform. Now you can use your GH Link card on Goyle POS machine to purchase fuel. GH Link card offers additional payment option for fuel purchases at Goyle stations, and in addition to the Go card. Every fuel purchase is recorded automatically on your monthly statement, helping cardholders track and manage their expenses. So, my friends, go ahead and use your GH Link card to buy fuel and all lubricants from any of Goyle's over 400 stations across Ghana. Go cashless and protect yourself and stick to all the COVID-19 protocols in these times. Goyle, good energy. Goyle, Nhyira Addo. It's very interesting. Goyle is even promoting record keeping by providing, the records of every fuel purchase that's done using this card. Businesses are often said to, at the start, you're not an accountant. Have a big dream of starting something great, but you're in this small space. You're recording. You go to lunch with a prospective customer. You pay for it. How do you ensure that in collecting all these records, is there a way, or is just record everything that you spend?
That is what we were calling bookkeeping. It's essentially recording.
Okay.
Every transaction or event or operation concerning the business.
Yes.
And since it's money, it's monetary terms. Like that is all that there is, bookkeeping. So I went to lunch today with so and so. I bought fuel so and so. Then I also mentioned what we call source documents.
Yeah.
They are usually documents that go with your purchases, your sales, and so on. For example, Goyle promoting this, it gives you some, what's a coupon,
A receipt,
whatever.
yeah.
So all these give evidence that you actually spent the money or you received the money. So we can tell you, take a box, or if you are better, you take an ARC file. Each of these receipts religiously
File
them.
them and keep them. Okay.
Take a notebook or a diary with you. Anytime you make a payment, write it down. Anytime that money comes to you, write it down. Of course, if you are giving receipts and so on, they are what I call the source general. So when the accountant comes, right, this is data. He's the one who's going, oh, this one is business promotion entertainment. This one is fuel. This is vehicle maintenance. This is TNT that you gave to so and so. This is your electricity bill. Then he will classify. That's why I say that the accountant comes to analyze. All that you are being asked to do is write them down. I understand even with your Momo, if you use Momo, you cannot get a statement out of it.
Yes.
But then you will probably have to tell them that, oh, this, you see names. So this person you gave the money to, what
it
was it?
for this and it was for
so
that.
So you now have to provide a bit of information. So if you will stick to that, then you have it. And I also mentioned that is as far as you, the owner who started this business, can go. Because there are other things that the accountant will now come in for. You bought a vehicle, and so he will now, what you said, he will now bring in these things of depreciation and so on. Or you gave a loan, or no, you gave credit sales somebody, so it's your debtor. You find out the man has not died. How do you treat it? Is it an asset, or he will tell you how to write it off and so on? For those, he will use what we call journals. So the other things, when he's questioning you, he will bring. But what you have is what we call incomplete accounts. So the accountant will help you and fit in the pieces to come up with what is acceptable.
But essentially, all of this starts with you.
Yes.
Ensuring that you are providing the data out of which
because
the
you can be
can
the bookkeeper. You don't need any special skills to be the bookkeeper.
Fantastic. This is Masterclass, and I'm Nhyira Addo. I'm sitting in for Yao Banafo, who's your regular host. Phone lines can be open now, and I think we also will want to hear from you if you have questions. Do send us your thoughts on handles on Twitter at Joy99.7 FM. And let's take a short break, and when we come back, we'll open the phone lines and hear from you.
Your favorite on-air business development program, Joy Business Masterclass, is in session, and you can interact with us on Facebook via the Joy 99.7 FM or Joy Business pages. If you tweet, the handle is at Joy 997 FM or at Joy Business GH. Don't forget to hashtag JB Masterclass. You can also call us on 0302 216541 or send your questions and contributions through to the WhatsApp number 0551 111997, and our facilitators will address your concerns. Attention everyone, class is in progress.
Welcome back, and this is Masterclass coming to you live from our studios here in Kokomlimle, Joy 99.7 FM, and the phone lines can be accessed by dialing 0302 216 541 or 055 1111 997. So today's show is brought to you by Goyle, Good Energy, Goyle Yanarayede. And we've been learning quite a lot, and I have a few questions just before we start taking calls. Now, can bad corporate governance affect bookkeeping?
Oh, definitely. Good governance by itself means doing the right thing.
Right.
And if you're not doing the right thing, then obviously you're not getting the right information across.
Okay.
Now, let's take a different slant. We have something we call management override.
Okay.
That means you've set up a company, you have just a handful of staff. You've put certain rules there. Then you keep violating the rules. For example, a simple one that official vehicles are used for official purposes. So everything is parked there. Then you now take it and give it to your wife, and she drives it to, say, Kumasi and back. And the fuel costs and things. The accountant doesn't know. Is it a company cost or we have
a personal cost? Okay.
That is a sample of that type of example. And if you keep doing these things often, you see, the business owner often says, "Oh, this is my own business. I want 5,000. I want this." And sometimes the accountant says, "Yes, sir. What did you use this money for?" "Oh, find somewhere to fix it," and things like that. So a time comes when, okay, he'll fix it somewhere. But when somebody is doing a review certain things are picked up easily. You'd be surprised at the kind of things that any seasoned accountant can pick by just looking at your financials. Some 5-10 minutes they can tell you these accounts are being cooked because you don't know the relationships too well. But in Ghana, that is the point, that if you look at a lot of financial statements, you won't see dividends. But they are living quite well, which means the business is successful to some point, obviously.
So maybe they take the dividend at the start.
So it means they have found a way of taking monies out. So now, if a would-be investor comes and he's looking at it, nah, they don't declare dividend because it's a key sign. You invest on the stock exchange. What are you taking?
Well, of course, you
Dividends
want some dividends out of it. Absolutely.
So you set up a company and then it's big enough and no dividends. Then any outside person looking at your business will start to be suspicious from the very beginning.
Of course, because if you are not making any profits, living well, and you expect me to come and bet on your business with my money.
Yes. You see, so those are some of the things that, look, declare dividend. And if you ask them why they are not declaring dividend, it's tax they claim they are dodging. And it's just 8%. So if you pay the 8%, and then you get a better capital structure. You see, look at any time you come across any financial statement, you look at it. You will find maybe the business was set up 6, 7, 10 years ago with maybe just 10,000. And that capital hasn't been touched. It's still 10,000. But you find a retained profits figure can even be as high as 5 million, right? Or they've even valued some properties sometime in the past. So you have some revaluation reserves in there. So if you look at the equity funds, it's a significant figure. But what you actually have there as stated capital is
it's still the start, the money that was used to start.
The figure and retained profits, you can decide to take it all out today. So if an investor is coming, he realizes, hey, I can put in money right now, a person can say this is and take it out. So all those are becoming red flags. You want to be serious, then transfer some monies into the capital, make it commensurate and correspond with, so you put up a building, you put up this, you did. Because if you get 1 year of a catastrophic event like COVID, it can wipe up so much of your profits. And although the whole equity funds or shareholders funds would have reduced, if you are transferred to capital, even though it may be negative, everybody will see the kind of capital that the owners have actually put it.
Yeah.
Because when you leave it there, there's a risk that one day can be wiped out. So when you're telling the people that, look, it's the way you presented your financials that has given these kind of indicators. So if you have a better understanding of the implications of various figures in your financial statements, you will be a bit more careful about them. Now you understand that this is a risk, because it's all about risk.
That's right.
Anybody looking at your financial statement, looking at it at risk. And let me give you a simple example, because sometimes people, a staff of one of the financial institutions, he was offered a better deal, maybe a few thousands more per month. And he wanted to now resign from where he had been maybe 10 years and go. A few of his friends said, look, I've sort of heard a few things about this company you want to go to. Why don't you go and dig around a bit and have a sense of, whatever. And he went 2 months later, that bank was closed down or that financial institution was closed down by the regulators.
The regulator.
So all of a sudden, there he was unemployed and he couldn't go back. All because even as a staff, an employee of a company,
he failed to do due diligence.
You have to. Yeah, so if you're in a company, you have to also try to see what is happening. Is my future guaranteed? If not, maybe it's time to look for another option, and so forth. So these are some of the things that people have to reconsider all the time.
Yeah. You've taken us through quite a number of things. You've explained what assets are, liabilities, both when they're current and otherwise. You've talked about how gross profit and net profit is derived. What is revenue? What is sales? Cash flow. And what I would also like for you to run us through would be, where do you see the place of tax and also insurance in this financial conversation?
Yeah, basically, if you own, say, a vehicle, you are a company and you insured it comprehensive, if it's a risk mitigation method.
Okay.
So the car was involved in an accident and was a write-off. If you didn't have insurance cover, it's a total write-off. If you
And
had
a cost to the business.
yes,
A loss.
Yes, a loss.
Yeah.
You have to write it off. But if you insured, and the insurer replaced it, you mitigated loss.
Okay.
So insurance is likely to mitigate losses. If it's over your staff, certain unforeseen events take place, and the insurance company has to come in. It's all to mitigate losses. That's what insurance is essentially doing in financial statements.
That's right.
To help that aspect. Now, the second aspect is about the cash flows. Now, the whole point is that at the end of the day, it's the cash that is determining. People make the mistake of thinking we are calculated profits, so that automatically means that we have cash. So sometimes you look at financial statement, you might discover that the person seems to be doing well, but you go and look at the cash balance.
Cash balance and it's small, yeah.
Yeah, because there are some things perhaps they have played games with and it's reflecting. For example, again, let me use a microfinance because people ask a lot of questions at that time. You are computing interest. It doesn't mean you've got the cash for it. You know, I've taken a loan.
But I'm
This month's
calculating the
supposed to be-
interest.
yes, you are calculating it monthly.
And
the
my
person
hope
saw
is that
pay.
you will pay.
And the person didn't pay. So your P&L is showing that, you are doing well. But it does not reflect in cash
Because the cash has not
it's
arrived.
growing as a loan balance or a debtor balance.
Yeah.
Are you getting me? So, you might just suddenly find one, you seem to be doing well, you don't have cash. Or the other day, I was asking, people have assets and they don't have cash. Yes. If you go and buy a whole year's supply of, say, A4, for example, you locked up the money for a whole year. But if you are buying monthly, you could use the money for something else,
As and when it's required.
Yes,
So there's a
because-
little agility.
and all of that is hard to manage. That's why I'm saying that anyone looking at your accounts will look at
Certain
current
things and
assets and very quickly, because
current
that is a very
liabilities.
quick way of knowing whether you are managing liquidity well, because that is very important.
Because without cash flow, really, you're stuck.
Yes.
Because that gives you, from my understanding so far, cash flow is what gives you your day-by-day fuel, essentially, to run the business.
What we call working capital.
That's right.
It's essentially the working capital. That's money you use to pay salaries. You have to buy something. There's always a pool of funds that should be available that enables you to meet the expenses as they come up, including some contingencies. So it's not just enough. Like most of us, you probably know how much you generally keep in your pocket. That if you beyond this, then I'll have to go to an ATM. But you generally have an idea of that's the same thing in business.
Wonderful. All right. So if you would like to field a few questions, please call us on 0302 216 or 055 111 We'll be happy to take questions and comments from you as we discuss this all-important subject matter of bookkeeping and accounting. We go into business for different reasons, but ultimately to make a profit. And that's cash, money. If you don't keep the books properly, as you say, it will be evident to someone with the eye to understand these things that you have not been prudent with the opportunity of managing and growing that business, and that could cost you. I think we have our very first caller on the line. Hello, good afternoon.
Yeah, good afternoon, sir. How are you?
Very well, thank you. Could you identify yourself and tell us where you're calling? Is that Kofi?
Yeah, this is Kofi from Accra.
Oh, fantastic, Kofi. So tell us if you have a question, shoot.
Yeah, I have. And Nhyira, it's been ages. Good to hear from you. Anyways, I want to find out. I mean, if you put up a business here in Ghana, you most definitely must comply when it comes to the laws, because oftentimes we are told that those in the informal sector or those who run these sole proprietorship business, as the man was saying, taking money anyhow. I mean, sometimes it's difficult to track some of those things if not done properly. And we live in an economy. They use the roads. We all use the roads. We all use the lights and everything. So everybody must pay the taxes and also keep their books well. So is there any regulation, governing even sole proprietorship, or this only goes for limited liability companies? Because I haven't heard a man saying that even when it comes to dividend payments, and I know dividend is paid to people who are holding shares in a company. Okay. So even if this can be done at that level, how much more sole proprietorship. So how is this tackled? And also, it's just so sometimes you wonder why the tax authorities will not educate people. Fine, this program is educating people. I mean, it's a good thing. But then, shouldn't this be done on one-to-one basis? Because I see revenue officers all the time going to these informal people. Shouldn't they teach them how to keep their books? Shouldn't that be something done freely so that GRA can, take the required taxes? Must it always be that you go and seek consultancy somewhere before you can understand what a fixed asset is and all of that? Thank you very much.
Thank you very much, Kofi, for that question, and we'll get answers in a moment. But I think I've got Kojo on the line. Good afternoon, Kojo. Hi, Kojo. Good afternoon. Could you speak up a little bit? Hello.
Hello. Good afternoon.
Good afternoon, Kojo.
Yes. We're having a press conference at the Akosombo tomorrow, and my colleague has been trying to reach you, join you.
Okay, if you'd stay on the line, the production team will handle that call. But if you have a question or a comment to make, do call us on 0302-216-541 or 055-111-11997. Kofi's question is very interesting. That, dividends are often paid to shareholders. And in a sole proprietorship, there's only one shareholder. Do these principles apply?
You see, when you're a sole proprietorship, it's more or less you and the business are one. Right? The limited liability company gives you protection that the business is separate from you. So if you're a sole proprietor, it means that if you borrow money or you are under any kind of liability, it can hit you personal.
Okay.
So in the accounts of sole proprietorship, it's slightly different from what it is in a limited liability company. So you will find that the owner's profits, right, there's also drawings. That means he can take in and out, all right? And at the end of it, the net figure is what is sort of recorded.
Right. So there's some fluidity in
yes,
that.
a bit different.
Okay. Fantastic. We'll come into that in a moment. I think I have Oti Boating on the line. Oti, good afternoon.
Afternoon, Nhyira.
I trust all is well with you.
Everything is okay.
We thank God for that. Could you fire your question, or if it's a contribution you'd like to make?
I'm a tailor, and only one person. I have a acquaintance. All of them have gone, so left only me. So bookkeeping, I try to keep some books. But what he's saying, if I'm going to some places, should I take my books? Normally, I write my expenditure and my income. That's why I do it. I have a book, and I learned from multimedia station. I think one of the stations, the director has to teach us how to keep the book. So I always take, after till I saw one dress, I write it down. Then I buy a stiff, buy the light for my shop, everything. I write it down. I say that's my expenditure of my business. So how can I make it so if I'm going to look for a loan in company, should I take the books, I write it down, the income I have the monthly, because I have a book already write everything I do.
Well, Oti Boating, you're on the right course. From what I've learned, you're doing bookkeeping, but the expert is right here. Mr. Kwaw De-Graft Johnson.
Mr. Oti, well done. That's bookkeeping. And any accountant coming to you will be very happy. Now, he is going to translate those things in the right perspective. You see, the financial statements, there's a format, there's a way it is prepared. So he is going to take what you have done and work on it. For example, I don't know whether you pay yourself a salary, but the accountant will ask you, what kind of salary are you giving yourself? In which case, he's going to ask you, is it a salary? Are you paying your pensions and things, or no? You are just doing anyhow. He's going to start to guide you on certain things about, because when you take some of these things to a finance institution, they will look at all these things, your statutory payments and things. You may be overlooking it, but it is important for your own self that this business that you are in, if it's a sole proprietorship, you see differently. But if, assuming you've registered it some kind of way and you are recording, then at this point is when you need the accountant who come and prepare it the way that the bank will be satisfied with. This is why you can't prepare anything and take it to them. As we have been trying to explain, there's a way it is done.
And that's where the accountant comes in.
And it's when it's been done that way.
Yeah.
And even then, the law demands, depending on what kind of organization you are, that call an independent person called the auditor, who is like the one that you can trust, that let him come and look at these things and sort of give some kind of opinion. Is it true and fair? Is it fairly reliable? So you can call an auditor and he'll say he's not comfortable then, and he'll qualify the accounts.
Okay.
There are ways they qualify that this one I'm not sure of because of this and that, but otherwise everything is so. And these all make a difference.
Okay. Well, I'm sure that the insights you've provided will certainly make a difference.
They can pay us a visit. We'll
absolutely. And my guest has been Mr. Kwaw De-Graft Johnson. He's a senior finance consultant at Firstcode Management Services. And so 3 things to take away. Make sure you record. Make sure you organize. Make sure you keep the right attitude and do what is required of you for your business. This has been Masterclass with me, Nhyira Addo, sitting in for Yaw Banafo. And thank you for tuning in. I'm handing you over to my man, Sammy Forsing, to continue with Ignition. Thank you.
Classical Lover Show is the world's greatest classical compositions from the 17th to the 20th century. A unique combination of concertos,